Hey, you wonderful people out there. Chris here from the Business Report Show. It looks like the markets are continuing their tight trading ranges this week, although different indices are definitely hitting their new highs. And we are seeing some additional bump up for U.S. recovery stocks as vaccination rates continue to climb and various states begin announcing plans for a full reopen. Now, before I go any further, as a disclaimer, I'm not a financial planner or advisor, and everything I say in this video is just my opinion and for education purposes only. So today I want to give you an update on the whole Archegos situation and the fallout that continues. If you haven't watched my first video about this, make sure you check out on the link above and go through it as I walk through in detail the analysis of what happened, why certain banks are in the situation they are right now, and what I think is going to happen in the future. Now, as an update to the situation, it looks like heads are starting to roll at some of the lending institutions caught up in this whole Archegos meltdown. On Tuesday, Credit Suisse announced several high-level staff departures, including investment bank CEO Brian Chin and Chief Risk and Compliance Officer Lara stepping down from their roles immediately. I imagine there will be many others in senior management roles that will be axed, but of course, we probably won't hear about those cuts. Really, the purpose of making these announcements of high-profile departures is to hopefully maintain the confidence of shareholders that the board of directors are taking this situation seriously. Credit Suisse also announced a cut to their dividend, which makes sense since Credit Suisse announced on Tuesday that the preliminary financial estimates for Q1 is a pre-tax loss of approximately $950 million after taking a $4.7 billion charge on the loss due to the Archegos meltdown. Now, this charge is definitely on the higher end of the estimates that were made last week, but mainly because it looked like the other investment banks involved were able to unload their positions earlier before Credit Suisse did. This part really speaks to the dog-eat-dog world of investment banking, as it was reported that the major investment banks actually met together a few days prior last Friday's public announcement to discuss how they would coordinate the sell-off without shocking the markets. So clearly a couple of them turned around and decided to unload on the stocks anyways. This has now been confirmed as CNBC reported on Tuesday that Morgan Stanley unloaded on $5 billion worth of Archegos holdings on Thursday, the day prior to the public announcement of the margin call. Allegedly, it appears as though Morgan Stanley reached out to a select group of hedge funds and offered them shares tied to the Archegos portfolio at a discount. It is also reported that these hedge fund managers were not told that these shares were tied to the situation specifically relating to Archegos, and that other major investment banks were also involved and also needed to unwind their positions. As we can only guess at this point, while these hedge funds bought the shares at a discount, the share prices probably continued to fall beyond that discounted price as major blocks of shares were sold even into late last week. Now, according to the CNBC report, these hedge funds were told that Morgan Stanley was unloading the shares to save a client from collapse. Clearly, Archegos is done, and now the hedge funds who bought those shares are probably pissed, but I don't think much will come of this because many of them need access to Morgan Stanley's platform to get premier access to lucrative investment opportunities such as tech IPOs. It was also reported that these trades went pretty much hidden as the trades were executed with only a small handful of hedge funds. So let's be honest here, this happens all the time and isn't the first time trades have gone largely hidden from the public, so to speak. I think this further exposes everything we've always guessed happened at the Wall Street table, which is that the big players get access to ways to profit that most retail investors like you and I don't. I think this also shows you and just how far removed us retail investors are from the Wall Street table, and that sometimes we lose this investing game by default just because we don't swing a big enough pocketbook. Both Morgan Stanley and Goldman Sachs have also drawn criticism as they were the main book runners for raising capital in the Viacom CBS secondary offering not many days before the whole Archegos meltdown, and some could say that it was the cause of the whole meltdown. Now, while Goldman Sachs spokesperson has indicated there are many communication controls and barriers that exist to ensure each division maintains its independence, it does raise a question whether the capital raising division and the investor division knew about the impending margin call. What we have seen so far is that the losses at both these investment banks are minimal, and because they were the main book runners for the secondary offering, they have earned commissions from raising the capital, from trading the securities for their clients, and they also minimize their losses on unloading the levered positions on behalf of Archegos. Another question that has been raised by some analysts is the structure of the European banking system, and if this has exposed even more flaws in their universal banking system. Now, through the UBS concept, you have the combination of investment banks and commercial banks. Essentially, a bank institution can be a one-stop shop for investors and businesses alike to get financing, and for individuals and businesses to place their cash for deposits in savings and checkings, as well as trade in securities like Archegos did. Some economists believe this is a risky proposition and that having these various service offerings separated and run by different entities is actually the best structure possible for the integrity of the financial system. Now, my personal opinion is that no matter what financial system or structure you have, you cannot get rid of the inherent greed of human beings. Without specific legislation and financial regulations in place that make it illegal for individuals at financial institutions to operate in a certain manner, we will continue seeing this type of behavior emanate from the large financial institutions. Not to say Canada is the best example of proper financial regulation, but here in Canada, we utilize pretty much the universal banking system, whereby our big banks are able to offer multiple services all under one brand. So for example, all the big banks do have a retail banking division, they have an equities trading division, they also do mortgage lending, they have a wealth management division, and so on and so forth. So each bank has specific rules and regulations that they must follow in order to set up a firewall between each division to ensure conflict of interests are minimized. These regulations kept the Canadian banks relatively unscathed during the 2008 financial crisis in the US. Again, not to say that Canada is a perfect regulatory system, but it shows you that maybe universal banking isn't really the issue, because on the flip side, during the 2008 financial crisis, we saw the collapse of Lehman Brothers and Merrill Lynch that wreaked havoc on the entire financial market. To me, it comes down to regulations that prevent individuals or groups of individuals from making decisions that create conflict of interest that shake the integrity of the overall financial system. So back to Credit Suisse, in terms of announcing the cutting of their dividend for the next quarter and the foreseeable short term as they try and rebuild their balance sheet and use their cash to cover their losses. They also indicated that bonuses are suspended. Oh, how thoughtful of them. Credit Suisse is not only dealing with the Archegos meltdown, but also a series of other bad transactions, including Luckin Coffee and most recently Greensill Capital, a company that Credit Suisse bought. Greensill Capital was set up as a fund to conduct factoring transactions, and this is a form of financing that allows suppliers to receive early payment for their invoice at a slight discount. For most factoring companies, they take out insurance policies on the invoices just in case an entity fails to pay that invoice and they can't collect. It is alleged that Credit Suisse did not confirm with the insurance company that bought out the insurance company that Greensill Capital used that the policy was still valid. Apparently, the new insurance company has indicated that there are concerns about them covering the policy due to an employee that overexceeded his underwriting authority. In other words, they are not covering any potential liabilities from factoring invoices that are not paid. Credit Suisse ended up freezing $10 billion worth of funds to Greensill after finding this out. So a couple weeks ago, Greensill hired Grant Thornton, the accounting firm, to look at possible insolvency and restructuring proceedings. Clearly, there are many issues within Credit Suisse when it comes to due diligence and authorizing funds for risky transactions. But the real question is, how many other large European banking institutions and North American investment banks have similar issues that are looming in the background? Clearly, we haven't learned from the last financial crisis that these creative investment structures, derivatives, and leverage transactions can cause massive hits to the overall financial system. That is, these processes and ways of doing business seem to still be unchecked, and these entities continue to do what they do for the sake of bonuses and shareholder gains. I guess it's pretty much given that the next market blowup will come from a self-made situation by the big players at the table. Well, that's it for today's video. I just want to update as this situation continues to evolve with the whole Archegos and Credit Suisse meltdown. Make sure to leave your comments below with your thoughts on this whole situation and what you think the regulators should do or what you think they will probably not end up doing. And if you haven't done so already, make sure to hit that subscribe button and like button, as every little bit helps. Don't forget to check out my other videos, and for those of you following my Wealthsimple Small Cap Trade Challenge, I will have an update coming shortly on some positions that I've added and some positions I've exited. As always, remember to always be learning, always be investing. I'll catch you in the next video.